Welcome to House Lux Estate, your go-to channel for all things real estate and investment. Here, we demystify the complexities of the property market, providing you with insights and strategies to navigate your investment journey. And today, we're tackling a topic that's often misunderstood: the tricky terrain of leverage. Yes, that double-edged sword that can either catapult your wealth or send you spiraling into debt. Stay tuned as we delve into how leverage can make or break your financial future. First things first, what exactly is leverage? Well, in the most basic terms, leverage is a strategy that allows you to amplify your potential return on an investment by using borrowed money. Imagine it as a tool that can magnify your financial power, allowing you to invest more than what you currently have. Now, leverage is a common practice in the financial world. It's often used in real estate, where investors might take out a mortgage to buy a property, or in stock trading, where traders might borrow money to buy more shares. But here's the thing. While leverage can magnify your gains, it can also amplify your losses. Think of it like a magnifying glass. It can help you see things more clearly, but if you're not careful, it can also focus the sun's rays and start a fire. While leverage can boost profits, it's a double-edged sword that can lead to devastating losses. Let's take a look at our first case study: an overconfident investor. Let's call him John. John was a savvy investor, or so he thought. He had a few successful trades under his belt and his confidence was soaring. He believed that he had cracked the code to making big money fast in the stock market. John decided to use leverage to maximize his profits. Leverage, in simple terms, is borrowed money that is used to invest in something with the expectation of higher returns. John was certain that his chosen stocks would perform well, so he borrowed heavily to invest more than what he had. This is where his overconfidence started to cloud his judgment. John didn't have a proper risk management strategy in place. He was so sure of his decisions that he didn't consider the possibility of his investments not performing as expected. After all, he had been right before. Why would this time be any different? But the stock market is unpredictable. And unfortunately for John, his chosen stocks didn't perform as well as he had anticipated. As the value of his investments started to decline, he found himself in a precarious situation. He wasn't just losing his initial investment, but also the borrowed money, which he still had to pay back. What's worse, the lenders started asking for their money back as they saw the value of John's investments plummeting. This is called a margin call, and it's every leveraged investor's worst nightmare. John had to sell his investments at a loss to pay back his loans, resulting in significant financial losses. In the end, John's overconfidence cost him dearly. He not only lost his initial investment, but also ended up in debt due to the borrowed money. His story serves as a cautionary tale for all investors. Investing without a proper risk management strategy and letting overconfidence guide your decisions can lead to financial ruin. This case shows us that overconfidence and lack of risk management can lead to financial ruin. Our second case study tells the story of an impulsive speculator. Let's call him Sam. Sam was an individual who had a knack for spotting trends. He believed he could predict market movements and used leverage as his tool to amplify his potential gains. Sam started small, making bets on the fluctuations of commodities prices. His initial successes gave him confidence. He believed he had the Midas touch, and soon he began to use leverage to multiply his bets. The more he used leverage, the bigger his potential profits. It was intoxicating. Sam was hooked. However, what Sam didn't fully comprehend was that leverage is a double-edged sword. Yes, it can amplify gains, but it can also magnify losses. And in the world of speculation, the markets can be as unpredictable as a summer storm. One day, Sam made a massive bet on the price of oil, expecting it to rise. He borrowed heavily to fund this bet, leveraging his investment to the hilt. But instead of rising, the price of oil tanked. Sam was left holding the bag. His losses were not just his initial investment, but magnified many times over due to the leverage he had used. Sam's story is not uncommon. The allure of quick profits and the thrill of the gamble can often cloud judgment. But here's the thing: speculation is not investing, it's gambling. And when you add leverage to the mix, you're not just betting your money, but also the money you don't have. Sam's tale ended in financial ruin. His impulsive decisions and misuse of leverage left him broke. His story serves as a stark reminder of the dangers of speculation and the perils of leverage. It's crucial to understand the risks involved in using leverage and to use it judiciously, if at all. This case reminds us that speculation and leverage can be a dangerous mix. Remember, the goal of investing is not to get rich quick, but to build wealth over time. And that requires patience, discipline, and a sound investment strategy, not impulsive bets and reckless use of leverage. Our final case study focuses on an uninformed borrower. Meet Jane. Jane is a hardworking individual with dreams of owning a home. She decided to take a leap of faith and took out a sizable mortgage loan to purchase her dream house. However, Jane didn't fully comprehend the terms and conditions of her loan and failed to understand the implications of high leverage. Jane was under the impression that the low interest rates at the time of her loan would remain constant. The reality, however, was quite the opposite. Her loan was a variable rate mortgage, which meant that the interest rate was susceptible to changes in the market. As the economy fluctuated, the interest rates began to rise, leading to an increase in her monthly payments. Jane was not prepared for this change. The increasing monthly payments began to take a toll on her finances. She found herself struggling to meet her monthly obligations, and her dream home started to feel more like a financial nightmare. What Jane didn't realize was that when she signed the dotted line for her loan, she was taking on a significant amount of risk. She was relying on a stable economy and steady income to manage her debt. Unfortunately, neither of these factors are guaranteed. As her financial situation worsened, Jane was unable to keep up with her payments, and she was forced into bankruptcy. This unfortunate situation could have been avoided if Jane had a better understanding of her loan terms and the implications of high leverage. She didn't fully appreciate that higher leverage could magnify her losses as well as her gains. And she didn't plan for the possibility of increasing interest rates, which escalated her monthly payments and ultimately led to her financial downfall. Jane's story is a cautionary tale. It's a stark reminder that while leverage can amplify potential returns, it can also intensify losses. And without a solid understanding of the terms and conditions of your loans, you could find yourself in a similar situation to Jane. This case underscores the importance of understanding the terms and conditions of your loans. Now that we've seen how leverage can lead to financial ruin, let's summarize the key points. We've walked through 3 distinct case studies, each illustrating a unique pitfall of leverage. Our first case was that of the overconfident investor. Overconfidence can be a dangerous trait when dealing with leverage. It often leads to reckless decisions, such as taking on more debt than one can handle or investing in risky ventures without proper due diligence. The downfall of the overconfident investor serves as a stark reminder that investing isn't a game of chance, but a discipline that requires thorough research, careful planning, and a keen understanding of the market dynamics. Next, we delved into the story of the impulsive speculator. This case highlighted the perils of speculation, particularly when fueled by excessive leverage. The speculator's tale is a cautionary one, reminding us that impulsive decisions and short-term thinking can lead to devastating financial consequences. It underscores the importance of a well-thought-out investment strategy and the need to resist the allure of quick, high returns. Our third case study introduced us to the uninformed borrower. Lack of knowledge about how leverage works can be just as detrimental as overconfidence or impulsivity. The borrower's downfall was a result of not fully understanding the terms of the loans and the risks involved. This case emphasizes the significance of financial literacy, particularly when it comes to complex financial instruments like leverage. So, what can we learn from these stories? When used wisely, leverage can be a powerful tool, allowing us to amplify our investments and potentially reap substantial rewards. However, it's crucial to understand that leverage also magnifies risks. It's a double-edged sword that requires careful handling. Effective risk management becomes paramount when dealing with leverage. This involves setting clear investment goals, understanding the market, diversifying your portfolio, and most importantly, knowing your risk tolerance. It's also crucial to stay informed and keep learning about financial markets and instruments. In conclusion, while leverage can open doors to lucrative opportunities, it's not without its pitfalls. Overconfidence, impulsivity, and lack of understanding can turn this powerful tool into a destructive force. But with careful planning, sound decision-making, and continuous learning, we can harness the power of leverage to our advantage. Remember, leverage is a tool that can help or harm you, depending on how you use it. Thank you for watching HouseLux Estate. Don't forget to subscribe for more insightful videos on real estate and investment.